Hello and welcome to the RM2 webinar on using enterprise management incentives or EMIs in an EOT owned business. Today your presenters are me, Richard Cowley, and my colleague John Dormer. Just before we get into the presentation proper, just a little bit of housekeeping. The presentation should take about 30 minutes. We are going to do a Q&A exercise. However, we are not going to do, we think we're going to run out of time in terms of 30 minutes. So we're planning on taking your questions and then sending a group answer out to all attendees after, well, probably next week. So if you have any questions, please let us know. You'll find a drop-down box for questions on the menu on the right-hand side of the screen. So please just put those questions in. If you have any confidential questions, you can email me or John. The email addresses, I know I've just taken them off, but they will be, you can't hear me at all. Okay, well, that's a problem. I don't know what to do. Okay. Okay. My webcam is also Hello. Welcome to the RM2 webinar. I think we just had a bit of a technical problem in that our microphone wasn't working, so we've just had a quick replacement of microphones. Sorry for the inconvenience. I'm going to go backwards because I think that nobody actually heard the introduction. So we are talking today in the webinar about using enterprise management incentives or EMIs in a EOT owned business. Your presenters today are me, Richard Cowley, and my colleague John Dormer. The email addresses are below. They will also be given at the end of the webinar. If you have any, if you want to contact, no sound. It's working. Yeah. Apologies for this. We've still been reported that I wasn't having any sound, but I think it's now resolved. As I said, it's me and John, my colleague. Now, just a little bit of housekeeping before we get into the presentation proper. Well, we were hoping that this presentation was going to take about 30 minutes, but it's probably going to take about 35 minutes because we've just wasted 5 minutes. So apologies for that. We are planning on taking questions. However, we think that we're not going to have time to answer those during the webinar, but we are very eager to have your questions. You will find a drop-down box if you would like to give questions on the menu on the right-hand side of your screen. Please enter them at any time. What we're going to do is collate all the questions and give answers to them and then send them out to all attendees. If you have a confidential question, please mark it as confidential because otherwise everybody else will see your answers. Also, this webinar is being recorded and will be available on the RM2 website. If you're Googling RM2, please put RM2 partnership, because if you just put RM2, you'll find a company which can sell you pallets, which is probably not what you want. We also have a YouTube channel. Okay, so we are now going into presentation proper. So effectively, topics for the day is basically why would you use EMI options in an EOT owned business? Because the very fact that you're using an EOT means the business is already owned by your employees, and therefore why have a different form of share scheme. So we'll go through that. We'll talk about the benefits of EMI by themselves, and then some of the technical sort of qualifying conditions for EMI schemes, and then actually just to sort of round it off, a bit of an alternative to EMIs, which may be suitable for some companies, and then sort of key issues in terms of designing the right kind of EMI scheme for your particular company. Okay, so I thought we would start by just a little bit of a refresher in terms of our experience of why owners and companies do a EOT transaction in the first place. Now, this is not a complete list of all the objectives that an owner might have. It's just a selected few which we think are particularly relevant for using an EMI scheme. So the owner, we find, it's not actually the headline in terms of EOTs, is basically that you can sell your business tax-free. We find that usually is not one of the top objectives for owners. So the kind of things that owners are always talking about is leaving a legacy, leaving a company to go forward into the future, looking after their employees, keeping the business intact, having a clear succession plan, and rewarding those successors that have helped them build the business to the success that it has at the point that the owners are considering exiting. We think that an EMI model with an EOT transaction helps all these objectives be completed or be met. So just also in terms of EOTs, because these are setting up an EMI share scheme with an EOT transaction may have some consequences for the way that the EOT works in the future. And actually, it is possible, if you set up an EMI share scheme, to make your EOT non-compliant with legislation, which is not a place that you would want to be because of the clawback characteristics of an EOT tax incentive. So first and foremost, the trust must own a controlling stake. However, although a large percentage of businesses a large percentage of owners will sell 100% of their shares to the EOT, actually all you need is 50% plus one, and any number above that. So what that means effectively is that if the trust is just owning a controlling stake, it allows employees or other people to directly own 50% less one share as the maximum amount. It gives you plenty of scope to allow employees to be able to have a direct ownership as well as potentially having the indirect ownership via the trust. Just something to bear in mind if you're considering actually setting up an EMI with an EOT transaction, that effectively if your EMI gives one of your colleagues or yourself more than a 5% shareholding in the company, in any of the classes of shares, effectively that makes you a participator, which excludes you from being a beneficiary of the trust. Being a beneficiary of the trust really only matters if the company is going to be sold by the trust, but it's still an important aspect that should be considered. Also, and very important if you're setting up a share scheme very soon after the EOT transaction, not to forget the limited participation rule, which effectively means that those people owning more than 5% of the equity in any class's share must only make up at most 40% of the total employee base. So if you meet the limited participation rule before the transaction, but then set up a whole load of new equity stakes, effectively you could find yourself non-compliant, and again that would be a clawback mechanism for the tax incentive. I just wanted to sort of have a general, in terms of the overall sort of scheme of why an EMI scheme is good for an EOT transaction. It's to talk about EOT transaction risk. Now, we think that EOT transactions are probably about the most gentle way in which you can have a change of control within an organization. And that's because the characteristic of an EOT transaction is effectively the company can be very similar after the transaction, if not the same as the company before the transaction, i.e. there's not that much hit to or change within the company. However, doing an EOT transaction, possibly at the very least, will indicate to your staff members that potentially key members of the management team and key directors are considering an exit, which can be somewhat disconcerting for colleagues, and therefore it can have some level of some level of change risk within the business. Also, in terms of when you're doing an EOT transaction, most EOT transactions are funded by vendor debt, which is then paid off by the profits which the company makes after the transaction. It kind of, so part of the benefit to employees is the fact that they will have the potential to have a profit share in their company going forward. But if you're paying off debt, the profit share may be relatively small, if anything at all, for the next 5 to 6 years while the company's paying off the debt. This potentially leads to staff kind of not really understanding what the benefit is for them in terms of the EOT transaction. This is all very important because we think the key part of the success of an EOT transaction is that you actually retain your key staff in order to take that business forward. And so the EMI share scheme counters the difficulties that an EOT transaction might have in terms of staff not particularly understanding the benefits which are going to come to them, and therefore you can kind of enhance the benefits for some of your key staff in order to effectively handcuff them to the business in order to drive that business forward for the foreseeable future. So in summary, so why use an EMI options in an EOT owned business? So we think it helps meet those owners' objectives that we were first talking about. So effectively, the key thing is basically that the business carries on as if the post-transaction, so that the owner gets their legacy. You want the business to be intact, effectively for the employees to have their jobs intact and then eventually move on to a full profit share. And deciding on which of your key colleagues may actually be recipients of an EMI option scheme would effectively almost address the first part of actually who is going to be the successor for potentially the owning director who may be exiting at some point. And certainly the EMI option scheme for an EOT transaction is can be a highly beneficial benefit for those people who are lucky enough to be able to take it. Also, the EOT legislation caters for EMI option schemes, and frankly, we kind of believe that almost a hybrid model is preferable to the pure EOT model, where there's the indirect ownership. And that's all about sort of retaining your key staff and allowing the business to flourish and incentivizing those key staff to drive that business forward. Therefore, you de-risk the EOT transaction, i.e. the business stays, you retain the key staff to move the thing forward. It facilitates the business for the company's development because, again, you are starting to address your succession plan. And just going to, we talked about retention, just going to touch base. The reason that an EMI option scheme can be so beneficial for your staff that are lucky enough to receive it is because there's a characteristic of an EOT transaction. Effectively, you sell at a price, but for most EOT transactions, they are funded by debt. The valuation of the business, therefore, post-transaction, immediately after the transaction, as a characteristic of an EOT transaction, will fall very significantly. As a result, the EMI options, the exercise for those prices, can be very low compared to what it was before. It's almost like a once-in-a-lifetime opportunity for your colleagues to be able to buy into their business at a very low price. And the last point in terms of incentives, there's an incentive for your colleagues in order to work hard to clear the deferred consideration, because all EMI options will have conditions attached to them. And one of the key conditions, unlike a normal sort of EMI where most of them are exercised at an exit event, most EOT EMI options are exercised at the point when the deferred consideration is paid to the owner. And therefore your colleagues, your next generation of directors have a clear incentive to get the deferred consideration paid off as quickly as possible. So we're now going to get into more of the detail in terms of how EMIs work and how they are setting up. So I'm going to pass you over to my colleague, John Dormer, who will take you through most of the rest of the presentation. And
Thank you, Richard.
Small technical issue.
That was a handover. EMI is often described as a win-win for the business and employees together. And I thought it'd be worthwhile just highlighting some of the key issues benefiting both those employees and the business itself. As Richard's mentioned, EMI can be used as a means of providing a really meaningful direct stake in a business, and that's a direct ownership stake for key employees. Economically, it can enhance the profit share return for employees via a dividend stream, and can allow recipients of EMI options to benefit directly from capital growth. And there's potential there through the dividends and through the capital growth for potentially far more significant financial returns for those participating employees than they would get through a wholly indirect ownership model. Aligned with that, there's a number of cost and tax efficiencies that come with EMIs that many of you will be familiar with. So no upfront investment or tax costs when the options are granted. They can be income tax and employee NIC free when the options are exercised, or that can be limited. And CGT should apply on sale of the shares, with the relaxations to business asset disposal relief, which offers a 10% return, with no requirement for the 5% holding, and the clock for BADR starting when the options are granted. As far as the company is concerned, there's significant commercial flexibility, as Richard mentioned, in terms of how those options are actually designed. So they can be focused on specific objectives, repayment of the debt, or other personal or business metrics that are appropriate to the option holders. Importantly, valuation agreement can be obtained from HMRC with the benefit of what can be fairly significant minority shareholdings discounts. As many advisors will be aware on the call, the facility to get agreement from HMRC has been eroded over the years, so this remains one of the few circumstances where you can get that tax and valuation clarity up front. They can be employer NIC free or reduce that liability on exercise. But unfortunately, and this is one of the quirks with the EOT legislation, is that there's no corporation tax relief when the option is exercised. Although a company can be independent for EMI purposes, it's not for the purposes of the CT relief. So no corporation tax relief in the way in which non-EOT businesses can benefit from. So in terms of the qualification conditions for EMI, again, a lot of these will be familiar to advisors on the call. Independence is a key one. Options can only be granted over a company that's independent, the top company within the group, but there is a relaxation within the EOT legislation for companies that are subject to an EOT. The gross assets test, 30 million or less, applies at grant. A restriction on your number of full-time equivalent employees, under 250 at grant of the options. The business has to be trading with a view to realisation of profits, and investment activities there can cause a risk in terms of EMI qualification. You need a UK permanent establishment and have qualifying subsidiaries, typically over 50% of the ordinary share capital in those companies. And there is a specific EOT issue just to be aware of, in that if you do have a company limited by guarantee, that is the corporate trustee of the EOT, and the EMI company is the member in that company limited by guarantee, that company will constitute, the EOT company will constitute a subsidiary, but won't be a qualifying subsidiary. So just a point to pick up on in terms of that structuring. Companies limited by shares, no problem at all, but companies limited by guarantee, there is that bear trap there. No excluded activities to any substantial extent. HMRC's rule of thumb is 20%, and the employees have to be full-time, 25 hours a week or 75% of their overall paid time, and have no material interest in the business. So assuming that you can't qualify for EMI, but you're looking at targeted incentives for senior management rather than all employee, what can you do? Well, direct share awards, awarding a share interest up front to key employees, could be perceived as being more tangible. A share certificate in their hands, status, entry onto the register of members can have those intangible benefits. However, as many people will be aware, direct share awards are less commercially flexible when compared to options. The ability to weave in vesting criteria can be far more difficult through a use of direct share awards, and the need to claw back shares from leavers can take more doing than obviously a lapsing of an option. Importantly, from a tax perspective, a direct share award creates a tax point, so it requires an investment or a tax hit, or to acquire the shares on a nil or partly paid basis, in effect a promise to pay the market value at a future date. Importantly, as Richard has mentioned earlier, there's a window of opportunity following an EOT transaction which results in a reduced equity value. So that upfront tax hit, that upfront investment cost, can be minimised in the context of an EOT transaction to minimise that liability. There is, however, no HMRC valuation agreement that's available. So professional advice on the specific class of share or the shares that are being awarded to key managers is pivotal in those circumstances. CGT can apply on growth in value, and the all-important Section 431 elections have to apply in order to secure that treatment. If a direct share award isn't preferred, and there's a number of reasons why in terms of that commercial clunkiness as to why you might not want to go down that route, it's well worth having another dust off of the company share option plan, or CSOP. This is an HMRC tax favoured plan. And interestingly, there's a government review on the extension of the scope of CSOPs to see how it can support businesses that aren't EMI qualifying. There are share capital conditions, but no gross assets, full-time equivalent employees, excluded activities or qualifying subsidiary requirements. One of the real areas where CSOPs have been hamstrung for many years now is the valuation limits. Just £30,000 worth of shares per employee valued at grant, compared with 250k under an EMI. But as we both mentioned, in the context of an EOT transaction, 30k's worth of shares could go further than you might first imagine. You can get your valuation agreement from HMRC, and in the same way as applied to EMI options, typically those are discounted and take account of minority shareholdings. Unlike EMI, there's a 3-year wait for income tax and NIC-free exercise in normal circumstances, subject to certain lever provisions. And there's no equivalent business asset disposal relief relaxations under a CSOP. So still the requirement to have a 5% economic and voting shareholding and 2-year holding before those shares are disposed of. If you're looking at something that isn't targeted to specific employees, it's well worth focusing on the share incentive plan, or SIP, which can offer up to 9k's worth of shares per employee per annum. It's important to stress, however, that's an all-employee plan that largely has to be operated on similar terms, so can't be operated in the discretionary pick and choose way that the previous 3 share plans can. So, assuming that you do want to go down the EMI route, you need to drill down to the detail in terms of how those options will actually work. Many of these questions are not EOT specific, but some of them are. You've got to identify your incentive goals. So what behaviours are you trying to promote and target? Who should participate? Key employees who can genuinely help to drive business growth. How much, both from a pool perspective and individually within that pool? How much headroom might you actually need for future joiners who are required to take the business to the next level? And always having in mind the EOT controlling interest requirements that Richard mentioned earlier. When should you grant? Should you take the opportunity while the EOT debt level is significant, or defer grants until maybe you're more certain about particular employees? When should those options become exercisable? Should debt repayment be the trigger, or are there other conditions that might be corporate or personal? How affordable is it to actually exercise the options? Can employees afford to pay the exercise price? Do you need to look at granting options at a discount, or potential loan funding, or offering them a cashless exercise facility whereby they can sell certain of the shares in order to fund the exercise price? How will value be delivered? A key question. Are the dividends enough, or is there a long-term capital return that we should be looking for, or should be not guaranteed, but that a facility should be put in place whereby that can be realised? How do you want to deal with levers, both in their capacity as option holders? Should the options become exercisable? Should they lapse? How does vesting and performance targets interact with that? How do you define good and bad? Once employees have become shareholders, how do you ensure that you can buy back those shares and stop ex-employees from having a continuing interest in the business? How, again, are good and bad levers determined, and how should those shares be valued, and what price should they receive? Particular to an EOT transaction is the fact that there's unlikely to be another exit event. Never say never, but obviously the thrust of an EOT is that longer term sustainable business model. In the absence of an exit event, how and when will that capital value be delivered? That's aligned to the other two questions that follow. So if there is to be an internal market, who creates it? Does the company buy back the shares? Do you set up a new employee benefit trust to acquire them? Or are other shareholders who might retain an interest able to acquire them? That all links into how the shares will be taxed on sale, different treatments for company buybacks and through EBT buybacks, and for the length of time that shares have been held. And importantly, how should those shares be valued? Do minority holdings discounts apply, or can people sell on an undiscounted basis? And there's some specific tax risks that are associated with that goal. And finally, and possibly most importantly on the list, is actually how to communicate what you're doing, making sure that people actually understand the benefits of what they are being offered, both now and in the future.
Okay, so that was a bit of a whirlwind introduction to EMI options or EMI share schemes within an EOT owned business. Actually, I think I kind of add to what John was saying in terms of the design of any kind of share scheme which you're attaching to, in fact, any kind of share scheme period, is when you're talking to your advisors, always have ultimately your mind on what you're actually trying to create and what kind of benefits you're trying to give to your colleagues. I would go as far as to say is actually it should be part, if you're in the process of considering an EOT transaction, you really should consider doing a direct ownership through a share scheme at the same time. And I think your planning for the whole EOT transaction should incorporate what you're going to do afterwards and because that then gives you a much clearer way to communicate the benefits, especially to your key colleagues, the key guys who are going to take the business forward and potentially pay the owners the price that the EOT is going to pay them. Just to sort of finish off, one thing I forgot to mention, you can request a copy of all these slides in PDF form. Again, either email myself or John at the email addresses below. It'll probably be quicker if you email us, because those slides will come over straight away. And just a reminder, this webinar, hopefully without the technical issues at the start, will be posted onto our website in the next few days, in fact. Well, I hope you've found this discussion useful. If you would like to discuss either EOTs or EMIs or any other kind of share scheme in more detail, please drop us a line. Yeah, it went to 35 minutes as I predicted. So apologies that we've run over slightly. I hope you'll forgive us for our little bit of clunkiness at the start. But thank you very much for listening.
Thank you.